Okay, so we will begin with mutual fund. I had mentioned that a couple of sums on portfolio are still left and they are ambiguous, so I cannot leave them for you. Let's do that towards the end of today's class, okay? But we are starting with mutual fund because the class name is also mutual fund given, so we can't continue with portfolio like this, correct? So, write down. Mutual funds. Now it is very important to understand the level of this chapter, the level. The level is pathetic, it's very low. It's a very, very easy chapter, and that's the reason why in my normal Hindi plus English batch, this chapter is given for home viewing. Because it's so easy. We are doing it because I want all the classes to be there in English. In fact, many people might be doing this at home only because they are comfortable with Hindi. So, the chapter is easy. So, is it tested in the exam? Yes, every time. Important. The chapter, this time, in November 19 exam, showed up a complicated question, which was like, I will say out of syllabus, because nothing of that sort was given. I had done that stuff in my amendment class of old syllabus at Kalamandir, but I had never ever done that. So it was like, there are so many things I know, maybe one thing comes. So given that the institute has touched upon a new area in mutual fund, I'm a little bit afraid. So you will find me doing a lot of new areas in this chapter, in this curriculum, and they will be uploaded on YouTube, the new areas which I do, so that even other students can do the same, okay? In order to manage the two sides of the topic, as in one very easy, the other new areas, we will try to balance it like maybe one point I'm doing a very easy one, second point I'm going to a new area. So can it be done like this? Doesn't it require a rhythm? No, it doesn't require any rhythm. Because what about us? Normal people know so much about mutual fund nowadays. Mutual fund sahi hai. Okay, the abhiyan. So general awareness about mutual fund has also gone up like skyrocketing levels. So you can expect that if you are appearing for CA final, they definitely require that your level should be much, much higher. In fact, the FSCM paper, Financial Service Capital Market paper, is one which specializes in mutual fund, because there we have SEBI guidelines on mutual fund as a part of the curriculum. Okay? Let's write down exam focus. Exam focus. Point number one. Around 5 dash 10 marks. Around 5 dash 10 marks will come. Will come. Dash. Most probably practical. Most probably practical. Second bullet. A new sum on mutual fund. A new sum on mutual fund came in November 19 exams. Okay, I'm not remembering it was old syllabus or new syllabus, we'll check. A new sum on mutual fund came in November 19 exams. In November 19 exams. Dash, dangerous. Dash, dangerous. Third bullet. We will approach the topic point-wise. We will approach the topic point-wise. We will approach the topic point-wise. Dash. Easy plus different. Easy plus different. Okay, one easy topic, one different topic. Easy plus different. Last bullet. Mutual fund is totally connected to portfolio chapter. Mutual fund is totally connected to portfolio chapter. Mutual fund is totally connected to portfolio chapter. To portfolio chapter. Okay. Now let's begin. Point number 1. So just 1 second, please. Nobody should be expecting that I should discuss about what is a mutual fund. What are the benefits of mutual fund to the society? Let's not make it a BCom class. So does that stuff come in the paper? No, it doesn't. So if somebody will tell me later on, sir, you did not explain what a mutual fund is. I am acknowledging that everybody understands mutual fund is a pooled investment vehicle. Instead of directly investing your money in the stock market, okay, or in the bond market, you can put your money into a fund which is managed by professional fund managers, and they will invest on your behalf, earn returns, deduct the fees, and pass it on to you. It is very simple structure. There is no question of anybody feeling that I don't understand the very concept of mutual fund. Fine? Because if we are able to focus on differential things, then only our level will become. Point number 1. Performance appraisal of mutual fund managers. Performance appraisal of mutual fund managers. Mutual fund managers. Okay. Now by this word performance appraisal, what feeling are you getting? Ex post or ex ante? Performance appraisal of mutual fund managers, I'm asking you, you're getting a feeling of ex post or ex ante? Ex post. The year has passed by. How did the manager perform? Or if there are 4 managers, who performed the best, second, third and fourth? We are talking about performance appraisal, no forecasting. It's about the past. Is it okay? Now, in order to ensure that you are not thinking that I'm throwing formulas at you, let me give you some data and maybe you will come out with formulas. Have a look. RF last year was 6%. RM minus RF last year was 5%. Sigma M last year was 14%. Are you okay? There's a fund manager A. He had a portfolio whose beta was 1.6, whose SD was 20%, and whose return was 17%. Fine. Of course, there are other fund managers also. I do not want to crowd that over here. Let's focus on one fund manager. Now, we are supposed to find some measures to evaluate this manager against other managers. Like you have in capital budgeting NPV or IRR or profitability index, with the help of which you can compare some projects. Na? So we are wanting to have such formulas. There is one formula that you know, which is Sharpe ratio. What is the answer? Answer. Sharpe ratio of this fund manager. Please calculate. Sharpe ratio of this fund manager. Please calculate. Sharpe ratio of this fund manager. Please calculate. Yes? Point? What is the formula for Sharpe ratio? RP minus RF by sigma P. Correct? So 17 minus 6 divided by 20. 17 minus 6 divided by 20. What is point? 0.55. So 0.55 is the Sharpe ratio of this fund manager. 0.55 is the Sharpe ratio of this fund manager. Fine with you? We could also find out the Sharpe ratio of other fund managers and then rank them. Higher Sharpe ratio, second, third, fourth, fifth. No stress at all. Please don't be stressed. Relax and listen to the class. This is an easy class. In the last to last class, we did C star. Last to last class, we did C star. C star, the first step was ranking of the different stocks according to which ratio? No. Excess return to beta. In the C star, we first of all rank the stocks as per excess return to beta ratio. Are you remembering? Because we did it just one class earlier, na? Please calculate that ratio for this mutual fund. Please calculate that ratio, excess return to beta ratio. Yes, speak out. It's a big figure. 6.875 is the answer. Of course, you're not supposed to compare this with the Sharpe ratio. We are not sitting over here to compare some other ratio with Sharpe ratio. This ratio, excess return to beta, is called Trainer. Okay? Excess return to SD is called Sharpe. Excess return to beta is called Trainer. ICAI study mat gives them another name. Sharpe ratio is called reward to variability ratio. While Trainer ratio is called reward to volatility ratio. Reward to variability, reward to volatility. Reward means RP minus RF. Reward means RP minus RF divided by either SD or beta. If you divide by SD, it's variability. What is it? Variability. If you divide by beta, it's volatility. So many sums have come on Sharpe ratio and Trainer ratio in the CA final examination. There is no limit to it. People are prepared with those sums anytime. There is no issue at all. In fact, in one sum what happened, which I was so surprised, that how can students be so less prepared? I don't remember the sum exactly. What happened is that the Sharpe ratio was given. Sharpe ratio was given. And SD was given. So the student could have found out RP minus RF. Sharpe ratio was given. SD was given. The student could have found out RP minus RF. Then you were supposed to find out the Trainer ratio. So that RP minus RF which he found out, divided by what? Beta. And so many people struggled. This is like very easy stuff, na? You are given the Sharpe ratio, you are given sigma P, You put the sigma p, you get Rp minus Rf. Use that Rp minus Rf, divide by beta to get the training ratio. I hope you're okay. Okay? So, I was saying that we need to discover formulas or measures for ranking. So you have now known two formulas. What are they? Sharp and Trainer. What is the other name for Sharp? Reward to variability, variance, SD. And the other one? Reward to volatility. Perfect? Now instead of ratios, come to alpha. Please calculate alpha of this fund manager. Take your time. Please calculate alpha of this fund manager. For that you have to compute the SML return. Please compute SML. Please compute the SML return for him. Some body language please. Please compute the SML return for him. What she should have earned as per SML. That's very easy. What is it coming? 14. Because it's 5 into 1.6 plus 6. See people, I can easily give you formulas. But then you are following, you are not interacting with me. So I'm deliberately not giving formulas, wanting you to apply your brains, and then we have everything ready. So you said 14%. 14% is okay with all of you. 5 into 1.6 plus 6. 14% he should have earned. How much has he earned? 17%. How much extra? 3% is called Jensen alpha. It's called Jensen alpha. You had learned alpha equal to ER minus RE. That was ex ante. What was that? Ex ante. This is ex post. Ex post alpha is actual return earned by the fund manager minus the required return as per SML. To make the formula a bit easy to pick up, I will call it return minus SML. What? Return minus SML. Hope you will be able to tackle. RP minus SML. Correct? 3%. SML tells you the required rate of return given the systematic risk or given the total risk. Think and say. SML gives us the required rate of return for the systematic risk or for the total risk. Systematic. You put beta. You put beta. Anybody who remembers the formula for CML? Capital market line. Capital market line. RE equal to RF plus Sharp ratio into sigma P. RE equal to RF plus Sharp ratio into sigma P. Sharp ratio of the market portfolio, highest in the world. What is the Sharp ratio of the market, please, on the board? What is the Sharp ratio of the market? 5 by 14. Sharp ratio of the market is 5 by 14. Can you see? 5 by 14. Please multiply 5 by 14 with 20. Please multiply 5 by 14 with 20. Plus 6. 13 point. It should have been more than 14. So I've given some information which I need to rectify. Just 1 second. If the correlation between sigma p and sigma m is 0.9, please calculate beta. 0.9 into 20 by 14. 0.9 into 20 by 14, please. 1.29. So that was a mistake. I took a beta so high, which is making the correlation more than 1. If you back calculate the correlation with beta, I have taken a correlation more than 1. That's why I don't dictate now. I take my time. So I'm taking this as 1. Suppose 2. No issues. So please calculate the alpha again. Alpha. Remember? RP minus SML. 5 into 1.2 plus 6. What? 12. So 17 minus 12, 5. So alpha is 5%. Now CML, 5 by 14 into 20. 5 by 14 into 20 plus 6. 13.14. Now, there is a 12% return. There is a 13.14% return, there is a 17% return. Again, there is a 12% return, there is a 13.14% return, there is a 17% return. 12 is the return he should have earned for the systematic risk. 13.14 is the return he should have earned for the total risk. So 1.14 is the return he should have earned for the unsystematic risk. This was the new stuff in this exam. 12% is the return he should have earned for the systematic risk. 13.14 is the return he should have earned for the total risk. So 1.14 is the return that he should have earned for the unsystematic risk. We call it return from inadequate diversification. Return from inadequate diversification. This guy constructed a mutual fund which he did not diversify. His portfolio had unsystematic risk. He was supposed to earn something more. So if he has earned something more, there is no sabashi. There is no great thing. 1.14 is not a great that thing he earned. But above 13.14 he was not supposed to earn. Because 13.14 captures all risk. He has earned 17. He has earned 17. How much extra in real terms? 17 minus 13.14. 3.86. This is called return from net selectivity or return due to superior stock selection skills. Return from net selectivity or return due to superior stock selection skills. This guy who did this is Pharma. You heard his name last class? Pharma. Levels of market efficiency. Pharma gave one slap to Jensen, who calculated alpha as 17 minus 12, 5%. He said that's wrong. 5% has two parts. One part is the return that he should have earned for inadequate diversification. And the other part is the return from superior stock selection skills. So in this exam, which came November 19, we were supposed to find out the return due to superior stock selection skills. Okay? Now, concept-wise you may forget, but formula-wise you won't. Formula is RP minus CML. RP minus CML. That was 17 minus 13.14. Return due to superior stock selection skills. While CML minus SML was 13.14 minus 12, 1.14. That's the return from inadequate diversification. And RP minus SML is the alpha of Jensen. So, earlier, prior to November 19 exam, 3 things were there in the syllabus. Sharp, Trenner, Jensen. What? Sharp, Trenner, Jensen. This time, a 4th thing has come into the exam, which is Pharma's measure of net selectivity. Pharma's measure of net selectivity. Right? Let's do it. Write down. So you have given point number 1, what? Performance appraisal of managers. Point number A, old stuff. Old stuff, dash, rank managers, rank managers, rank, R-A-N-K, rank managers on the basis of, rank managers on the basis of, dash, para change, first bullet, Sharpe ratio, S-H-A-R-P-E, Sharpe ratio equal to RP minus RF divided by sigma P. Dash, also known as, what was the name? Reward to variability. Reward to variability ratio. Reward to variability ratio. Reward to variability ratio. Second bullet, Trenner, T-R-E-Y-N-E-R, T-R-E-Y-N-E-R, Trenner ratio, T-R-E-Y-N-E-R, Trenner ratio, equal to, what's the formula? RP minus RF divided by beta P. RP minus RF divided by beta P. What's the other name? Reward to volatility ratio. Reward to volatility ratio. Reward to volatility ratio. Third bullet. Jensen alpha. Jensen, Jensen. Jensen, Jensen alpha or exposed alpha. EXPOST, don't write exposed, it's exposed, POST. Exposed alpha equal to RP minus SML. RP minus SML. RP minus SML. Para change. Let's calculate these. Para change. Let's calculate these from the following data. Let's calculate these from the following data. Let's calculate these from the following data. Okay, write down general information. General information about last year. General information about last year. General information about last year. Okay, now copy three things. RF, RM minus RF and sigma M. Please copy three things. RF, RM minus RF and sigma M. RF, RM minus RF and sigma M. Next line. Information about fund manager A. Information about fund manager A last year. Information about fund manager A last year. Information about fund manager A last year. Fund manager A last year. Dash. Para change. So copy beta P, sigma P, RP. Beta P, sigma P, RP. Okay, now you calculate first bullet, Sharpe ratio. Sharpe ratio for A. Sharpe ratio for A. Sharpe ratio for A. 17 minus 6 whole divided by 20. 17 minus 6 whole divided by 20 equal to 0.55. Next bullet, trainer ratio. Next bullet, trainer ratio for A. Trainer ratio for A. So 17 minus 6 divided by 1.2. 17 minus 6 divided by 1.2. 9.17. Third bullet, SML. Calculate SML. SML equal to 6 plus 5 into 1.2. We are not writing the formula. I hope you are okay with it. Because there's so much of portfolio we have done. 6 plus 5 into 1.2. RF plus RM minus RF into beta. So 6 plus 5 into 1.2 is what? 12? 12%. Next line, therefore alpha equal to RP minus SML. Alpha equal to RP minus SML. So it is 17 minus 12. 5%. 17 minus 12 equal to 5%. Fine. Point number B. So this was 1A going on. Now we are moving to 1B. What was 1A? Old stuff. Okay. 1B. New stuff. 1B new stuff dash November 19 exam. New stuff. November 19 exam. November 19 exam. Okay. Para change, write down. Pharma, F-A-M-A, pharma. Calls Jensen alpha. Pharma calls Jensen alpha. Okay, open inverted comma. Return from total selectivity. Return from total selectivity. Return from total selectivity. return from total selectivity, close inverted comma, and splits that into two parts, and splits that into two parts, as shown below. Okay, please draw this chart. Please draw this chart. Even via algebra or standard costing, you will understand. I've done algebra. RP minus CML plus CML minus SML. CML cuts. What is it? RP minus SML. Correct? Now, RP minus CML is return from net selectivity or superior stock selection skills. Return from net selectivity or superior stock selection skills. Return from net selectivity or superior stock selection skills. Okay, the right side. Return due to inadequate diversification return due to inadequate diversification okay, where CML equal to, what's the formula? RF plus RM minus RF by sigma M into sigma P. The formula for CML, RF plus sharp ratio into SD. RF plus RM minus RF by sigma M into sigma P. Are you fine? Next line. Pharma concludes that performance appraisal should be based on Pharma concludes that performance appraisal should be based on Pharma concludes that performance appraisal should be based on Pharma concludes that performance appraisal should be based on net selectivity. Should be based on net selectivity and not total selectivity. Pharma concludes that net selectivity should be, performance appraisal should be based on net selectivity and not total selectivity. Parachange. Let us carry out this split up. Let us carry out this split up. Let us carry out this split up for fund manager A. Let us carry out this split up for fund manager A. Let us carry out this split up for fund manager A. This split up for fund manager A. Okay, so please calculate CML for fund manager A. Our data is given. CML equal to, you are doing 6 plus 5 by 14 into 20. You are doing 6 plus 5 by 14 into 20. 6 plus 5 by 14 into 20. Six plus 5 by 14 into 20. 13.14%. 13.14%. Next line. Therefore, return due to inadequate diversification. Return due to inadequate diversification. Return due to inadequate diversification. Return due to inadequate diversification equal to CML minus SML equal to CML minus SML equal to 13.14 minus 12. 13.14 minus 12 equal to 1.14%. Next line. Return from net selectivity. Return from net selectivity. Return from net selectivity equal to RP minus CML. RP minus CML. So 17 minus 13.14, what? 3.86%. 17 minus 13.14, 3.86%. Okay, please show the break. This was 5% alpha. We broke those into, what did you say, 3.86 and 1.14%. Understood? So this should be used for ranking. So that was the sum in the exam, in the November 19 paper. So nobody knew this, because if you are not taught, how will you know? It is not difficult. It is a question of awareness. Okay? Next. Point number C. Now what I am doing is that I am trying to go into other areas which have not been tested in CA final at all, but which are there in the industry, in the mutual fund industry. They are very easy. So whenever I find something it's very easy, it's under our control, it's good to be aware about the same. Maybe they will not come, but how much does it cost you to be just aware about the same? For that purpose, what was the Sharpe ratio of the portfolio? Sharpe ratio of the mutual fund manager you have computed now 0.55. What is the meaning of 0.55? Sharpe ratio 0.55. For 1% risk. For 1% risk, extra return is 0.55. So if the portfolio manager would have taken a SD equal to that of market, I repeat, if the portfolio manager would have taken a SD equal to that of market, what risk premium it would have earned? 0.55 into 14. 0.55 into 14, how much? 7.7. Think logically. The portfolio manager has taken a higher SD, 20%. I want to scale him down to 14%. If he took 14% risk, how much extra return he would have earned? So you did what? You calculated extra return per unit of risk. And then you multiplied it by the SD of market. It's making common sense. You all are very good in maths. But in these type of maths, you can understand this, what I'm doing. So 7 point what? 7.7%. So, sir, portfolio manager has generated a risk premium of 7.7% when we scale his SD with market SD. When we scale his SD with what? Market SD. He has earned 7.7% extra. What is the extra return or market risk premium? What is the market risk premium? It is there now, 5. What is the market risk premium? 5. So I'm trying to say, you're not understanding the tone. Can I compare RP minus RF with Rm minus Rf? No, I can't. Because Rm minus Rf reflects the risk of sigma m. Rp minus Rf reflects the risk of sigma p. I am not able to compare. So I am doing what? I find out this ratio and multiply it by sigma m, so that so Rp minus Rf by sigma p into sigma m shows me the risk premium generated by the portfolio at the level of risk of the market. Are you understanding? It's a strong logic. 7 point what? 7. But what is this? 5. 7.7 minus 5. What is it? 2.7%. This is called M square. This is called M square. When it will come straight away in the exam, everybody will be squared. You understanding? I had done this also in that Kalamandir class, amendment class. Because what do? I look at what are the stuff that the CA Institute has. Where are those stuff found? Okay, over here, over here, over here, over here, over here. What other stuff are over there which have not yet come? I have all it in my head now. So I know where have they taken it from, what is the other stuff. So it may come. Otherwise you can criticize that he was doing new things. Doing this does not cost you a lot because this was not new formula. It was Sharpe ratio of the portfolio into sigma m minus MRP. What is the formula? Sharpe ratio of the portfolio into sigma m minus MRP. But you will like this only if you understand, which I was trying to explain. That's how we can't compare Rp minus Rf with Rm minus Rf. Why? Because Rp minus Rf has a different SD, Rm minus Rf has a different SD. So sir, do something now. You scale down Rp minus Rf at the level of SD of the market. And then you compare with Rm minus Rf. If you understand, you will be appreciating this. Otherwise it's a formula. It's M square. What is it? M square. Performance measure. M square. Write down point number C. Related new stuff which has not yet come. Point number C. Related new stuff which has not yet come. Related new stuff which has not yet come. Related new stuff which has not yet come. Write down. M square. M square equal to SHRP. I think Sharpe ratio was denoted by SHR from the beginning. SHRP into sigma m minus MRP minus market risk premium. So how do you read the Sharpe ratio of the portfolio into sigma m minus MRP equal to Rp minus Rf by sigma p into sigma m minus bracket Rm minus Rf equal to 0.55 into 14 minus 5, 7.7 minus 5 equal to 2.7%. Okay, this is M square. What is it? M square. Number D. New. The topic is tracking error and information ratio, tracking error and information ratio. This is so popular in the industry, given in all books. Tracking error and information ratio, and very easy also. Listen. Now to explain this to you, just wait please. Period. Do not copy, wait. Return on the benchmark. Return on the benchmark. Every mutual fund has a benchmark. It will be compared with what? Benchmark. Return on the portfolio. Active return equal to RP minus RB. Active return, return of the portfolio over and above the benchmark. So if I have period 1, 2, 3, 4, 5, benchmark return 4%, 3%, minus 2%, 6%, minus 1%. Portfolio return 5%, 3.2%, minus 2.7%, 5.8%, minus 0.2%. Yes, please, difference. 1, 0.2, minus 0.7, minus 0.2, 0.8 positive. If you do one mistake in the plus minus, you are gone. You should know how to calculate the difference. Return on portfolio minus return on benchmark. It is RP minus RB. Total. Total please. 1.1. Let's take this column as X. So we have X bar is equal to 1.1 by 5. Yes, please. 0.22. This means we were looking at the portfolio return minus benchmark. On an average, it's 0.22% higher. On an average, the portfolio return is 0.22% higher than the benchmark. Correct? Suppose all these figures in this column would have been 0.22. 0.22, 0.22, 0.22, 0.22, 0.22. Still the total is 1.1 and the average is 0.22. If that would have been the case, every time 0.22 extra, how can somebody produce every time 0.22 extra? That means that extra that is producing is because of luck or because of skill. I expected an impromptu answer. If every ball a person is hitting 6, every ball, 6, 6, is it luck or skill? Skill. Okay. If he's hitting a 6, getting bold, 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 then 6, bold, it's luck going on. But every time he's performing, that's what? Skill. So we want to measure the standard deviation of the active return. Standard deviation of the active return. So we make a column for X minus X bar whole square. Help me. 1 minus 0.22. So 0.78 square. 1 minus 0.22. Please 0.78 square. 0.6084. 0.2 minus 0.22 is minus 0.02 square. 0.0004. Minus 0.7 minus 0.22 is 0.92 square. 0.8464. Minus 0.2 minus 0.22. 0.42 square. 0.1764. 0.8 minus 0.22. 0.58 square. 0.3364 total. Total please. Total please. Again 1.968. 1.968. Therefore sigma AR equal to root over 1.968 by 5. I hope you're okay. 1.968 by 5, the whole square root. Let's 2 decimal point. 0.63% is the standard deviation of the active return. So the average active return is 0.22% and standard deviation is 0.63%. So we calculate the ratio of the excess return to the SD. It's like the Sharpe ratio. Like in the Sharpe ratio divided by SD. Here also you take the active return divided by what? SD of the active return. It is called information ratio. Information ratio is equal to 0.22 divided by 0.63. 0.22 by 0.63, how much? 0.35. Just 1 second. If the Sharpe ratio is 0.35, the meaning is for every 1% risk, the excess return over and above RF is 0.35%. Here it means for every 1% tracking risk, for every 1% tracking risk, the excess return earned over and above the benchmark is 0.35%. It's called information ratio. And this 0.63% is called tracking error. It's called tracking error. You were supposed to track something, you did not track. Okay, what's the error in that? Tracking error. Okay, if you look at it mathematically, it is easy stuff. 3 columns will be given to you. Look at it from a numbers perspective, 3 columns. You will calculate the difference of return, RP minus RF. That is X. Calculate the mean and SD. Calculate the mean and SD. The SD is called tracking error. And the mean divided by SD is called information ratio. This is not difficult because you are looking at it not via concept but via numbers. With columns it's an easy stuff. Has it ever come? No. Okay? Tracking error, information ratio. Tracking error lower the better, information ratio higher the better. Okay? Write down please. Copy the same stuff. First column, period. Second column, return on benchmark. You have to write the word return on benchmark. Return on benchmark. Okay, RB. Then return on portfolio, RP. Then active return, write the full word. Active return, AR equal to RP minus RB. We call it X. AR equal to RP minus RB. Okay, we are calling it X. Active return. RP minus RB, X. Last column, X minus X bar whole square. X minus X bar whole square. Okay, you may now copy the figures. Last column figures we had computed together, so there is no issue in copying. Total of the last column is 1.968. Total of the last column is 1.968. Total of the second last column is 1.1. Total of the last column is 1.968. Total of the second last column is 1.1. So after the table, write down average active return, average active return, average active return, bracket X bar equal to 1.1 by 5, equal to 1.1 by 5, equal to 0.22%, dash higher the better, 0.22% dash higher the better, higher the better. Next line, tracking error equal to SD of the active returns, equal to SD of the active returns, SD of the active returns equal to root over 1.968 divided by 5. Okay, 1.968 by 5, the whole square root, equal to 0.63%, dash lower the better, 0.63% dash lower the better. Next line, information ratio. Information ratio, IR, equal to average active return divided by tracking risk. Average active return divided by tracking risk. Average active return divided by tracking risk. Average active return divided by tracking risk equal to 0.22 divided by 0.63. 0.22 divided by 0.63 equal to 0.35 dash higher the better. 0.35 dash higher the better. Higher the better. Fine. Point number E, the last extra point in performance evaluation. Okay, that means the maximum I think that can come. So A had already come so many times. B was extra, which came November 19. C was extra, M square. D was extra. Okay, and now E is extra. E is, write down, performance attribution. Performance attribution. This is also new. Performance attribution. ATTRIBUTION. Performance attribution. Dash. Allocation effect plus selection effect. Performance attribution. Dash. Allocation effect plus selection effect. Allocation effect plus selection effect. Allocation effect plus selection effect. Okay, listen. There's a head fund manager, and as per the investment committee policy guidelines, heavy statement, this means like every company has a top management committee which takes strategic decisions about the company. The same way, in a fund house, there's an investment committee, okay, which represents the client's interests, and they take major decisions. So according to the investment committee decisions, the top fund manager was told that you are supposed to put the entire money into 3 areas: equity, bonds, cash equivalent. Equity, bonds and cash equivalent, these are the 3 areas in which he was supposed to put money. The policy allocation, also called strategic allocation, that was told to him was 60%, 30%, 10%. So he was told, please put 60% of funds in equity, 30% in bonds, and 10% in cash equivalent. But this guy, he put 72% in equity, 20% in bond, 8% in cash and cash equivalent. So the blue figure is actual allocation, actual weight. The red figure is policy weight. Blue is actual, red is policy. So he did not adhere to what was told to him. Now why he did not adhere is obvious. He must have expected equity market to what? Equity market to really outperform as compared to bond market and whatever. Now, for the equity, the benchmark was Sensex. For equity, the benchmark was Sensex. For bond, there was another benchmark. And for cash equivalent, there was another benchmark. So the benchmark return is given. Return is 18%, 9%, 2%. Sorry, these are the benchmark return. I am just marking them in red. Benchmark return, which means the head fund manager, he allocated 3 different fund managers, one for equity, one for bond, and one for cash equivalent. To the equity manager, he told that, look, your benchmark will be Sensex, so you can easily put all the money in Sensex. He told to the equity manager, the benchmark is Sensex, so if you want to play safe, put all the money in Sensex. But this guy did what? He did not put all the money in Sensex. He invested according to his own understanding. He generated 22%. What do you find? He did good or bad? Good, as compared to the benchmark. The bond guy produced only 7%. Bad. Instead, he could have invested in the bond index. The cash and cash equivalent guy generated 2.2%. Good. So this is PW, policy weight. This is AW, actual weight. This is PR, policy return. This is AR, actual return. Okay? Return from the policy portfolio is PW into AW summation. Return from the policy portfolio is summation PW-AW. Since PW-AW is coming, you're not understanding, I'm saying weighted average. Weight into return, weight into return, weight into return. Which weight? The policy weight. Sorry. Return from the policy portfolio is PW into PR. Sorry. PW into PR summation. It's W into R. Which WR? P. So 0.6 into 18, 0.3 into 9, 0.1 into 2. This is weight into return. This is not new stuff. Return from the actual portfolio is AW into AR summation. Okay. So we calculate return on the actual portfolio minus return on the policy portfolio. If that difference is positive, he has outperformed. Actual portfolio greater than policy portfolio, good performance. Due to you scored good marks in the exam. Why? Attribution. Let me attribute. Sir, I think I'll attribute 20% because of your teaching. Say, okay, I'll attribute 30% because of my parents' support and all that, and 50% of my effort, brains. So it's attribution. How do you attribute your performance into allocation effect and selection effect? So allocation effect, selection effect is all standard costing going on. You have found out the material cost variance, and now you are trying to split it into the price variance and the quantity variance. You all people are better at understanding this split up. Okay? So, just to explain to you, the way I as a student always understood standard costing was like this. This is weight, this is suppose return. Now, this is suppose PW, this is suppose PR. So PW into PR shows the return on the policy portfolio. This is AW suppose, and this is what? AR. It shows the return on the actual portfolio. The difference is the entire area. You understand? The difference is the entire area. Now I need to split this area. Split this area. Okay? To split this area, there are two techniques. Sorry. There are two techniques. Yeah, one technique is split this into 3 parts. You understood? So this one part is the return effect, selection effect, AR minus PR. See na, AR minus PR, it is a selection effect multiplied by PW, the area of this rectangle. Area number 2 is AW minus PW into PR. This is the allocation effect. Allocation means weights. And number 3 is the cross product, Okay? Generally people find this to be complicated, and therefore we compromise. We do what? We will take this entire part as 1, which means selection effect is AR minus PR, difference of return, multiplied by actual weight, Whereas the allocation effect will be difference of weight multiplied by the policy return, You understanding? Okay. So one is the selection effect, the difference of return multiplied by actual weight, and the other is the selection effect, allocation effect, which is difference of weights multiplied by policy return. Got it? So that's what we will do. Okay? Such sums are filled in all other examinations. Of course, it is not. It is also there in CFA, but in CFA it's at a very, very high level. It's at a global level. We invest in different countries and currency effect and all that. It's done at 7, 8 levels. This, what I'm saying, is in MS Finance, Indian examinations where it is tested. This is filled up in Indian books. Okay, so this is easy stuff. This can come. And once you have done it, you will recall that there was something, the policy weight, policy portfolio, actual weight, actual portfolio. Okay, let's write it down. Consider the following data. Consider the following data. Consider the following data. Dash. So 5 columns. First column, asset class. First column, asset class. Second column, policy weight. Third column, actual weight. Fourth column, policy return. Fifth column, actual return. Okay, policy weight, actual weight, policy return, actual return. Okay, now just 1 second. It is not necessary that they will use the same language. What I am sure is that they will use the word policy weight, actual weight. But policy return is also called benchmark return. What return? Benchmark return. And the actual return is also called portfolio return. Okay, the PR is also called benchmark return. The actual return is also called portfolio return. Okay, please fill up the table. Equity, bond, cash equivalent. Okay, cash equivalent or money market, whatever. Equity, bond, cash equivalent. Copy this. 60, 30, 10, 72, 28, 18, 9, 2, 22, 7 and 2.2. 22, 7 and 2.2. Okay. Write down, calculate the value added by the portfolio manager. Calculate the value added by the portfolio manager. Calculate the value added by the portfolio manager and split it. Calculate the value added by the portfolio manager and split it into allocation effect and selection effect. Split it into allocation effect and selection effect. Allocation effect and selection effect. Okay, solution. Return from policy portfolio. Return from policy portfolio. Return from policy portfolio equal to summation PW PR. Return from policy portfolio is summation PW PR. Okay, do it please. Equal to 0.6 into 18 plus 0.3 into 9 plus 0.1 into 2. 0.6 into 18 plus 0.3 into 9 plus 0.1 into 2. Again? 13.7%. 13.7%. 13.7%. Next line. Return from actual portfolio. Return from actual portfolio equal to summation AWAR. Return from actual portfolio equal to summation AWAR equal to 0.72 into 22 plus 0.2 into 7 plus 0.08 into 2.2. 0.72 into 22 plus 0.2 into 7 plus 0.08 into 2.2. Again, 17.42%. 17.42%. 17.42%. Next line, therefore, value added equal to 17.42 minus what? 17.42 minus 13.7. 17.42 minus 13.7? Yeah. 17.42 minus 13.7. How much? 3.72%. 3.72%. He added value. Okay. 3.72%. I hope you are okay. It's easy calculation going on. Next line. Allocation effect. Allocation effect. So please understand, allocation means weights. So it's the difference of weights. Write down. Equal to summation AW into AW minus PW into PR. AW minus PW into PR equal to 0.72 minus 0.6 into 18. Okay, 0.72 minus 0.6 into 18 plus, let's come to bond. What was it? 0.2 minus 0.3, am I correct? Into what? 9 plus, tell me, 0.08 minus 0.1 into 2. Please calculate. Yes. 2 point Okay, 3.1%. 3.1% is the allocation effect. What was the value added? 7.2. So out of 3.7 to 3.1 is the allocation effect. So the selection effect, his choice of security is not very great. His allocation is very good. Okay, next. Allocation effect, selection effect. Selection effect means how do you choose securities? You don't invest in the Sensex, you choose your stocks, how good you are in that. Selection effect. Selection effect equal to summation AR minus PR. Okay, AR minus PR into AW. Summation AR minus PR into AW. AR minus PR into AW. So let's look at equity. So 22 minus 18, the whole into 0.72. 22 minus 18, whole into 0.72. Plus, help me, what? 7 minus 9 into point, actual weight, 0.2. Plus 2.2 minus 2 into 0.08. Allocation effect was wrong. Okay, allocation effect was wrong. Okay, allocation effect was wrong. It was 1.22. Allocation effect was wrong. It is 1.22. And the selection effect is coming to what? Yes, please. 2 point. Check. Take your time. Don't answer that way. It should be this much. No shortcut. 2.496. That is 2.5%. That's fine. 2.496 is 2.5. That's fine. Okay, 2.5%. So perfect, na? 2.5 plus 1.22 is what? 3.72. That's the value added. Perfect. We have split it. Got it? So I have been very transparent that point number C, point number D and point number E, I have done extra stuff which is not printed by ICI. If you want to leave, you can leave them. But since this area was tested from A to B, I went to C, D and E. Okay? Now, we will just stop back and see the sums over here. If some of the sums are extremely easy, which they are, in that case, I'll expect one thing from you. Since we are trying to reach at a higher level while investing the same amount of time, easy sums may be given as homework. I don't think that will be treated as, he did not do many sums with us. He's doing so many examples with you, na? Is it okay? So if the sums are easy or comfortable, you got to do the sums yourself after my guidance. Let's see. Page number 200, question number 8. Have a look. Page number 200, question number 8. Page number 200, question number 8. Please have a look. Page number 200, question number 8. The numbering of the pages have been done, okay, to match with my classes whose videos were given to that Hindi batch. That is why you find how come 200 over here. So don't apply your brains over there. Okay, page number 200 is right at the beginning. Page number 200, question number 8. So let's have a look. Following are the data on 5 mutual funds. Fund A, B, C, D, E, return SD and beta. Return SD and beta. You are required to compute reward to volatility ratio and rank these portfolios using Sharpe method and Trenner method. Don't you consider the language to be so stupid? Again, you are required to compute reward to volatility ratio. What ratio is it? Reward to volatility is trainer. Sharp is variability. So trainer, and rank these portfolio using Sharp and trainer. So what is he doing? Has he lost it? Why is he saying reward to volatility? When he's asking us to rank according to Sharp and trainer, we will rank now. Assuming RF is 6%. 1 minute. Do you understand what you have to do? We will first of all give a heading what? Sharp. And over there, we'll make a column for fund, then Sharp ratio, and then rank. Only 3 columns. What? Fund, Sharp ratio, rank. Please do it. Write down. Ranking as per Sharp ratio. Ranking as per Sharp method. Ranking as per Sharp method. Ranking as per Sharp method. So 3 columns, please. First column, fund. Second column, Sharp ratio. And third column, rank. So you are doing it fund A, B, C, D, E. Please calculate their Sharp ratio. RF is 6% at the end. Have a look. So 15 minus 6, 9 divided by 7. 18 minus 6, 12 by 10. 14 minus 6, 8 by 5, and so on. Do it. You can write the formula of the Sharp ratio in that column heading. You should actually write the formula of the Sharp ratio in that column heading. Second column heading. If you have to turn back pages and see the formula of Sharp ratio, in that case RIP. Okay? RP minus RF divided by sigma P. RP minus RF divided by sigma P. So first one is 15 minus 6, which is 9 by 7. Second one is 18 minus 6, it is 12 by 10, 1.2. Third is 14 minus 6, it's 8 by 5, 1.6. 12 minus 6, it's 6 by 6, 1. 16 minus 6, 10 by 9, 1.11. Please rank them in the last column. Speak out the ranks. 2, 3, 1, 5, 4. It's 2, 3, 1, 5, 4. Next table. Ranking as per reward to volatility ratio. Because he will feel we have not done the sum. Ranking as per reward to volatility ratio or trainer. Ranking as per reward to volatility ratio, that is trainer. Ranking as per reward to volatility ratio, that is trainer. Leave the space, please. Leave the space. We can't suffer this. Once again, 3 columns. And you see how beautifully these people have decorated it. Mutual fund, RP, RF, RP minus RF, sigma P. It's not required directly, it can be done. It seems good when flipping the page of the books, because I asked my publishing team to ensure that the font size is equal to the font size in the CA examinations. What happens over there is the font size is so big now. A small question, it goes into 1.5 pages, and people are psychologically affected. So it's good that that habit is there right in the class itself. Yeah, page number 218, problem 18. Page number 218, problem 18. Page 218, problem 18. There are 2 mutual funds, D and K. each having closed-ended equity schemes. Although the knowledge of closed-ended will not be required in the sum, and open-ended versus closed-ended cannot come in the SFM exam. It is considered to be very, very low level. Still, what we know is low level, what we don't know is high level. So we should know. In a closed-ended fund, what happens is that, like a company, when it comes out with an IPO, you subscribe for the shares, you become the shareholders. Now, if you want your money back, you have to sell your share in the share market. No? You can't go to the company and ask your money back. The trading of the share takes place on the stock exchanges. Closed-ended fund is that only. It comes out with a NFO, new fund offering. Those people interested, they buy the units, and then the window is closed. The shutter was raised. Okay, to distribute the units, collect the money, the window is what? Closed. Closed-ended. Okay, you want to trade on it? Go to NSE, BSE. I have always felt that nobody can forget the meaning of closed-ended. If they stick to the word closed-ended, okay, the window was closed, units were issued, then the window is closed down. Okay, the window was open, units were issued, now the window is closed. Now it is traded on the exchange. Open-ended, the window is continuously open. Every day you can buy and sell from the fund itself. Okay, the point is in understanding that yes sir, I've understood closed-ended versus open-ended. So each having closed-ended equity scheme. NAV on 31st December 2014 of the equity shares of D mutual fund is 70.71. NAV full form? Net asset value. Now you are aware that normal balance sheets or accounting is done on historical cost basis. But for mutual fund, balance sheets are drawn on a mark-to-market basis. The balance sheet of a mutual fund is mark-to-market every day, repriced every day. What is the main asset of a mutual fund? Investments. All the shares, bond that it is holding, they are revalued every day as per current market price. And accordingly, if we calculate assets minus liabilities, the whole divided by number of units, that's called NAV. Okay, you can call it book value per share, but it is not book value per share. Because in a normal balance sheet, assets and liabilities are at book value. But here these are at market value. So NAV is the true worth of a mutual fund unit. Are you understanding? So they are saying NAV of the fund at the end of December 14 was 70.71, consisting 99% equity and remaining cash balance. Yeah, every mutual fund has to hold some cash. And that of K mutual fund was 62.5, consisting of 96% equity and balance in cash. Wait. I want to ask you something. If both of them, both the mutual funds are having same investment objective, similar style fund, and K is holding higher cash while D is holding lower cash, that means who is more bullish about the market? D. D is more bullish about the market, invested 99% in the market because he expects the rise to happen. K is not that bullish. It is not that these things are required for doing the sum. But if within the sum we discuss some practical things, the retention level of those is far higher as compared to when you read them as blunt theory. Understood? Next. Following is the other information. Sharpe ratio is given for the two fund, Frenner ratio is given for the two fund, SD is given. That's what I was saying. Sharpe ratio is given, SD is given. Look at this. Sharpe ratio and SD is given. If you cross multiply 11.25 into 2, calci please. 11.25 into 2, 22.5 is what? RP minus RF. What is it? RP minus RF. And we know the Frenner ratio. So if you divide by the Frenner ratio, what was it? 22.5 divided by 15. 22.5 divided by 15. 1.5 is beta. 1.5 is what? Beta. 1.5 is beta. Of course, if you have not understood comfortably, we will write and do it, don't worry. But this was easy ratio. Like in ratio, we don't do. Current ratio is 2. Current liability this much. What is current asset? That way. It's like ratio. Okay. There is no change in portfolio during the next month. An annual average costage rupees 3 per unit for the schemes of both the mutual fund. I said the fund is going to deduct expenditure. Whatever is the expended. Na? So 3 rupees is the per unit expenditure, annual, not monthly, annual. So what's the monthly expenditure? 3 by 12? 0.25? 0.25. If share market goes down by 5%, if share market goes down by 5%, in that case, D will go down, K will go down to the extent of their beta. D will go down and K will go down to the extent of their beta, and beta will calculate. You calculated beta for D now. What was the beta for D? 1.5. So how much D fell? Tell me. How much D fell? 7.5%. Did D fell by 7.5% or did the equity portion of D fell by 7.5%? Equity portion. D did not fell. D also has 1% cash. That portion did not fell. The 99% portion fell by 7.5%. I hope you are understanding. For calculate expected NAV after a month for the schemes of both the mutual fund. We have to calculate NAV after 1 month. NAV after 1 month. Mostly we have done it for D fund. Just help me out, please. What was the NAV for D? What was the NAV for D? 70.71. So on the calci, do 70.71, 99%. 70.71, 99%. This is 70. Okay. So this is the equity portion. Make it fall by 7.5%. So you are doing 92.5% of it. 92.5% of it. 64.75. Add the cash, which is 0.71. Add the cash, 0.71. What is it? Whatever it is. Minus 0.25 expenditure. Minus 0.25 expenditure. 65.21. So 65.21 is the NAV at the end of the month. Let's check the answer. Where is the answer? Yeah. Next page, 65.21. Can you see that? 65.21. Once a person's brain starts running, he will feel he's appearing for a CPT examination. Okay? You want to experience the same again? Let's do for K fund. Let's begin. K fund, Sharpe ratio is 3.3. You got to have positive body language, 3.3. While SD is 5. So 5 into 3.3? 16.5 divided by 15. 1.1 is the beta. So 1.1 into 5%. 5.5, the equity portion will fall. 5.5% equity portion will fall. Let's come to K fund. What's the NAV? 62.5. Calculate 96%. 62.5, 96%. 60. Make it 94.5%. 94.5%. 60? 56.7. Add cash 2.5. Add cash 2.5 minus 0.25. 58.95. Understood? So the presentation part you can manage. There is no issue. Presentation part you can manage. This is the institute solution. You can manage the presentation part. Still, I am dictating the entire presentation for the D fund. Let's write down. In fact, you know something? In the exam, you should not do it separately, D fund and K fund. Whenever there are the same series of calculation, it should be what? Column, table wise. So if you would have drawn 3 columns, particulars, D and K, that's the best. Okay, do that way please. Particulars, then D, then K. Particulars, then D, and then K. But we will not fill up the K column, okay? You can do it yourself. I'll fill up the D column only. So, point number A, NAV, 70.71. I'm not filling it for K, okay? Point number B, equity portion, 70. Point number C, cash portion, 0.71. Point number D, Sharpe ratio. What is it? 2. Point number E, SD, 11.25. Point number F, therefore RP minus RF. RP minus RF, please write down, it is D into E. RP minus RF is D into E. So 22.5. Item number G. Item number G. Beta. Oh, sorry, not beta. Trainer ratio. Trainer ratio. Trainer ratio, 15. Trainer ratio, 15. What alphabet? H. Beta. Equal to what by what? F by G. F by G. 1.5. I. Fall, percentage fall equity portion. Percentage fall equity portion. Percentage fall equity portion. Bracket. 5% into H. 5% into H. So it's what? 5 into 2.5. How much? 7.5%. J. J. Equity portion month end. Equity portion month end. You can do in the bracket 92.5% of what was it? B. Option 92.5% of B. Am I correct? 92.5% of B. Yes, please. 64.75. Leave some space over there because you will have a space for 94% of K now. So you can leave just one line over there. So it's, what did you get? 64.75. Where did we reach? J, K. Item number K. Cash portion. Cash portion. Bracket C minus 0.25. C minus 0.25. C minus 0.25, yes. 0.46. L. NAV month end. NAV month end. Total of the two. What are the two alphabets? What are the alphabets? J and K. J plus K. J plus K. Answer? 65.29. 65.29. 21. 65.21. Fine? Please mark page 221, homework. Please see that in page number 236, question number 37 is repeated. Page 236, question number 37 is by mistake repeated. Repeated. We just did it. Many sums are repeated illogically over here. Okay. So that was performance appraisal of mutual funds. Some examples from my side and what has come in the exam. So we have completed one point, but that's a very important point. That's the focus area in the exam nowadays. Okay. We take a break. Okay. So let's look at the sum which came in November 19 examination. Yeah, this was the sum. Write down old syllabus, question number 4A. November 19, old syllabus, question number 4A. November 19, old syllabus, question number 4A. So what are we given? Return of a portfolio A and market portfolio for the last 12 months. Portfolio and market. Standard deviation is given, otherwise we had to compute. You are required to find out the monthly returns attributable to the sheer skill of the portfolio manager. Returns attributable to the sheer skill of the portfolio manager. This is what? RP minus CML. RP minus CML attributed to the skill of the manager. What part of the monthly return is attributable to higher risk assumed by the portfolio manager? CML minus SML. So in the first part, you are required to find out RP minus CML. In the second part, you are required to find out CML minus SML. Assume that the RF is 12% per annum and portfolio is fully diversified. This is heights of stupidity, the last line. If the portfolio is fully diversified, then CML and SML should be same. I don't know what happens to these people or the person who constructs the sum. Whatever. Write down please. Solution. RP bracket average monthly return. RP bracket average monthly return equal to, please do it on Calc itself, all of you. You have to add all the returns and divide by 12. The first one is minus 0.52 and all others are positive and all. First is minus 0.52, second is 2.2 positive, third is 2.17, 4.17, 2.04, 3, 1.99, 4, minus 1.38, 2.67 positive, 3.99 positive, and December 1.86. Don't add the SD. December 1.86. Whatever you got divided by 12. Write down 2.1825%. That's RP. Okay, it's monthly RP. 2.1825. 2.1825. Write down RM bracket average monthly. RM bracket average monthly. Same stuff, please do it again for the market. 0.82 plus 0.04 plus 2.8 plus 1.72 plus 0.27 plus 0.39 plus 1.95 plus 0.64 plus 1.53 plus 2.7 plus 2.52 and plus 2.09. Whole divided by 12. Yes? 1.46. This is RM. So you have RP, you have RM. Write down given sigma P 1.6223. Sigma P 1.6223. Sigma M 0.9498. Sigma M 0.9498. Next line. RM. Oh, sorry, RF equal to 12 by 12, 1%, because everything has to be month. 1%. Next line, therefore CML. CML formula, hope you remember. What's the formula for CML? RF plus sharp ratio into sigma P. RF plus sharp ratio into sigma P. That means RF plus RM minus RF by sigma M into sigma P. RF plus RM minus RF by sigma M into sigma P. RF plus, bracket open, RM minus RF by sigma M, bracket close, into sigma P. Put the figures. RF is 1, plus you computed RM minus RF by sigma M into sigma P. 2.23. 2.23%. 2.23%. No, he's wrong. What is it? 1.7. Okay, since there's a confusion going on. CML is RF plus RM minus RF by sigma M into sigma P. What was RF? 1. What was RM? 1.46 minus 1 divided by what was sigma M? 0.9498 into what was sigma P? 1.6 233 6223. So what is it coming to? 1.79. 1.79%. 1.79%. Next line, therefore, return due to sheer skills, return due to sheer, okay, whatever language they have used. They have used the word attributable to sheer skill. Return due to sheer skill equal to RP minus CML. RP minus CML, you have the RP. So please do it, RP minus CML. RP minus CML. Yes, please. Point 0.3925%. 0.3925%. 0.3925%. Number two, now listen. While doing the sum, while making you dictate, right now, just 1 minute ago, I became a little bit afraid. Why? Because I thought beta is not given. And if beta is not given, we have to do the whole lot of effort of calculating beta. Then why did they give us SD? Understood? Then I thought, okay, they have helped us in the last line. The portfolio is fully diversified. If the portfolio is fully diversified, correlation of the portfolio, not beta, correlation of the portfolio with the market is 1. Correlation of the portfolio. Now logically, portfolio fully diversified means correlation with the market is 1. But if they mean to say beta is equal to 1, if they mean to say beta is equal to 1, then there will be a different solution. If you ask me knowledge-wise, if the portfolio is fully diversified, it means beta of the correlation of the portfolio is equal to 1. Therefore, beta is equal to R into sigma P by sigma M. R into, but that will be same as CML. CML and SML would be what? Same. And therefore, the answer of the second part would be 0. Because the second part is CML minus what? SML. But if I go to the popular interpretation, portfolio is fully diversified means beta equal to 1. What? Then there's a logical answer. So we are giving 2 answers of second part. I don't know which one would be correct. That depends upon the solution. Okay, write down second part. There are 2 alternate solutions. 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 Dash. Para change. Solution 1. Portfolio is fully diversified. Portfolio is fully diversified means R equal to 1. R equal to 1, because you remember what was R square? Anybody? Coefficient of determination. It meant how much risk is systematic. So if the portfolio is fully diversified, R square equal to 1, the entire risk is what? Systematic. Okay, there's no unsystematic. R equal to 1. Next line. Therefore, CML equal to SML. CML equal to SML. Next line. So, return attributable to higher risk equal to return attributable to higher risk. Return attributable to higher risk. Return attributable to higher risk equal to CML minus SML equal to 0. Return attributable to higher risk equal to CML minus SML equal to 0. Conceptually, this is the correct answer, conceptually. But when we think about what that guy would be thinking, I think this is not the answer they will give. They'll give the second one. Okay? Write down para change. Solution 2. Solution 2. Solution 2. Portfolio is fully diversified means beta P equal to 1. Portfolio is fully diversified means beta P equal to 1. Beta P equal to 1. Next line. Therefore, SML equal to RM. Are you okay? I'm not writing the equation. SML equal to RM. Because if beta equal to 1, what is SML? You want to put, you can put RF plus RM minus RF into 1. SML equal to RM. RM equal to what? What was RM? What was RM? 1.46. Next line. Therefore, return attributable to higher risk. Return attributable to higher risk equal to CML minus SML. Return attributable to higher risk equal to CML minus SML. CML, what was CML? 1.79 minus 1.46. Yeah, this would be the answer by ICI. 1.79 minus 1.46 equal to what? 0.33%. 0.33%. Okay? And now my sixth sense is saying that this will be the answer and this is wrong. Because anybody who knows portfolio deeply, he knows the language portfolio is fully diversified means R equal to 1. It does not mean beta equal to 1. Because the portfolio may have cash, may have RF. So beta may not be equal to 1. Okay? You remember the way we started the chapter CAPM? There we learned that, sir, what do people do in the CAPM world? They invest in a combination of market and RF. So when they invest in market and RF, their correlation with market is 1, but their beta is not 1. Their beta is weighted average of 1 and 0. Understood? So it's wrong. I'm going to corner them when they come out with a solution. Second enjoyment. Okay? That time. But the problem is that that will not become very popular, because what becomes popular is Easy stuff, no, which people can understand. That too will go above the head of people. So nobody will be listening, they will be saying, nah, you shout. Ah. Okay, so that's the answer of this question. I was going to leave the question, it's good that I attempted it. Okay. Point number 2, write down point number 2 of mutual fund. We have just done 1 point of mutual fund up till now. Point number 2. What? This was old syllabus. You write down point number 2 of mutual fund. Okay, point number 2 of mutual fund. Direct investing versus investing via a mutual fund. Direct investing versus investing via a mutual fund. So there is a chartered accountant, and this person directly invests in the stock market. Since he's a professional, he has knowledge about the same. He's auditing, he has insider information. But he has to give time to invest in the markets because he has to track the economy, sectors. He has to gather the insider information. He expects to earn a certain return from direct investing. He is thinking, why don't I do something? Invest in mutual fund that saves my time. At that time, I can exploit more clients. I can exploit more clients, so my income will go up from the normal business. And mutual funds are good only. But then he remembers, mutual funds, they charge fees. They charge fees. They charge 2 types of fees. Initial fees and recurring fees. Initial fees and recurring fees. Now what is the difference? Suppose I invest 100 rupee in a mutual fund and the mutual fund charges initial fee of 6%. 6 is gone. The amount invested by me is 94. Okay? Mutual fund charges annual fee of 2%. That means if the mutual fund earns 18% for me, actually it earns 16%. Annual fees is also annual, return is also annual. So from the return, the annual fees is directly deducted, but the initial fees is not. Initial fees is only one time. So you are going to earn 16% of 94 again. So initial fee 6%, return of the mutual fund 18%, annual fees 2%. Calculate your return. This is the question. The answer is, I invest 100 rupee. It becomes 94. On the 94 we earn 16%. On the 94 we earn 16%. What is it please? On the 94 we earn 16%. 15.04. 15.04%. So how have we calculated? So 100 minus 6. Okay. This we have done 18 minus 2% of this, correct? That is 15 point what? 15.04%. Now prior to the November 19 examination, the sum that used to come in the exam is, by direct investing you can earn 15%. Initial expense of mutual fund is 6%, annual recurring fees is 2%. What should be the return on the mutual fund so that you are indifferent? We used to do 15 is equal to x divided by 0.94 plus 2. 15 is equal to x divided by 0.94 plus 2. 0.94 comes from where? 6%. X is the return of the mutual fund. So X divided by 0.94 and then plus 2 is equal to 15. I am solving. What are we getting? X is equal to oh, sorry. Yeah, I was in a hurry. I did it like this. It will be 15 by 0.94 plus 2. X equal to 15 by 0.94 plus 2. What is it? 17.96, it's 18 type na, that we had taken. So there was a formula we used to say, what? The indifference return of a fund is equal to the return you can earn from direct investing divided by 1 minus initial expense plus what? Recurring expense. Okay? The return that the fund should earn, indifference return, is equal to 15%. If you are not understanding this formula, let me explain. This X minus 2 is the net return. And the net return is earned on what? 94. And that gives you what? 15. By whatever way you suit it. Same, 18 minus 2, 16. On what? 94 is equal to 15. It's coming from there only. So this sum used to come in the exam again and again. And this used to be called the easiest sum because there's nothing to be done. This time they gave second part of the sum. First time, second part of the sum where they went to a CA. That the CA will also save his time. His time has money. So which one should we go for? Okay, write down please. What was the heading you gave? Direct investing versus investing via mutual fund. Okay, write down. Point number A. Old stuff. Old stuff. Dash. You can earn 15% by directly investing in the stock markets. You can earn 15% by directly investing in the stock markets. You can earn 15% by directly investing in the stock markets. By directly investing in the stock markets. Full stop. You are thinking about investing in a fund. You are thinking about investing in a fund. Investing in a fund whose initial expense is 6%. Whose initial expense is 6%. And annual recurring expense is 2%. Annual recurring expense is 2%. Full stop. What should be the gross return on the fund? What should be the gross return on the fund? What should be the gross return on the fund? Gross return on the fund. So that you are indifferent. So that you are indifferent. You are indifferent. Okay? So when I was discussing, I found I and you, both of us, did not like that X wala formula. So we do it like this. Solution. Gross return minus 2 into 0.94 is equal to 15. This is understandable, isn't it? So gross return every year, 2% also every year. So net return on what? On 94. Are you able to manage this? I think this is better. Gross return minus 2, 16%, that of 94%, equal to 15, which I should get. So we solve. So we get gross return is 15 by 0.94 plus 2. You know, this is the formula we were learning. 15 by 0.94 plus 2. Answer please. 17.96%. 17.96%. Okay. Point number B. New stuff. New stuff dash November 19 examination. New stuff dash November 19 examination. November 19 examination. Okay, let's look at the sum. Okay, 5A. Write down old syllabus. November 19 old syllabus, question number 5A. November 19 old syllabus, question number 5A. Mr. Alex, a practicing CA, can earn a return of 15% by investing in equity shares on its own. He is considering a recently announced equity-based fund in which initial expense 6%, annual recurring 2%. How much should the mutual fund earn to provide Mr. Alex 15%? The first part is done. The figures are matching. 17.96 is the answer. Second part. Mr. Alex's current annual professional income is 40 lakhs. He's earning 40 lakhs. His portfolio value is 50 lakhs. And now he is spending 10% of his time to manage the portfolio. If he spends this time on profession, on exploiting clients, his professional income will go up in the same proportion. So that means he's earning right now 40 lakhs. So 4 lakhs. But if you go mathematically, it is not going to be 4 lakh because right now 90% of his time is earning 40 lakhs. It should be 40 divided by 90 into 10, but I don't think they will do that. I think 4 lakhs. Did you understand what did I say? If you dig inside maths, so 40 lakh he's earning from 90% of time. So 40 by 90 into 10, which will come to 4.44 lakhs. So I don't know what these guys will do. But if you take it loosely, it's a 10% of 40, 4 lakhs. If they are human, they'll do 4 lakhs. He is thinking to invest his entire portfolio into a multi-cap fund. Obviously, a multi-cap fund is a fund which invests in large cap or mid cap or small cap, all cap, multi-cap fund. Assuming the fund's NAV will grow at 13% per annum. Okay, including dividend. So the return of the fund is only going to be 13%. We calculated 17.96% na, gross return in difference. The fund return will be 13%. You are requested to advise Mr. Alex whether he can invest the portfolio into mutual fund. If so, what is the net financial benefit? They've asked net financial benefit, which means it seems that the answer will be yes. He should invest in the multi-cap fund and we are supposed to quantify the benefit. So let us think logically. One of the benefits of investing in the fund is 10% of 40 lakh equal to what? 4 lakh. Is that fine? He was earning 15% by his own. That's gone. The fund is going to earn 13, but 13 minus 2 is what? 11. I hope you're okay. 11% of 94% of 50 lakhs. 11% of 94% of 50 lakhs. Are you understanding? His portfolio 50 lakhs, if he invests, 6% is shaved off. So 11% of 90% of, or don't calculate that, wait a minute. 11% of, or do something, 11% of 94%. 11% of 94% is what? 11 into 0.94 is what? 11 into 0.94 is what? 10.34, okay. So the effective return that Mr. Alex will earn through the fund is 10.94, but his return was 15. I repeat, effective return he will earn from the fund is 10.34, and from the direct investor of 15. So how much is he losing? 15 minus 10.34, Kelsey? 15 minus 10.34, 4.66% of 50 lakhs. 4.66% of 50 lakhs. So 2,33,000 is the loss by shifting to mutual fund, but 4 lakh is the gain. So the net benefit is 4 lakh minus 2.33 lakhs. 1.67 lakhs. Okay, so they give a lot of common sense over here. Okay, they gave a lot of common sense over here that 13 is the gross return. You calculate the effective return, 13 minus 2, percentage of 94, 10 point something, but here it was 15. So 15 minus 10, loss. But the gain is what? The time saved and the billing to the extra client. Compare that way. Perfect? Only one confusion. That income should be 4 lakh or 4.44 lakhs. So 2 solutions in the exam. Correct? Write down. Second part. Cost benefit analysis. Cost benefit analysis. Dash. Para change. Benefit equal to increase in professional income. Increase in professional income equal to 10% of 40 lakhs equal to 4 lakh. 10% of 40 lakhs equal to 4 lakh. Next line. Alternatively, 40 divided by 0.9 into 0.1 or 40 by 90 into 10. 40 by 90, the whole into 10 equal to 4.44 lakhs. So we are not knowing which one would be the answer, 4 lakh or 4.44 lakh. Next line. Cost. Cost. So within the heading cost, first bullet, return on direct investment. Return on direct investment equal to 15%. Next bullet, return from mutual fund investment after deducting all expenses. Return from mutual fund investment after deducting all expenses. Return from mutual fund investment after deducting all expenses equal to 13 minus 2, the whole percentage of 0.94. 13 minus 2, the whole percent 94. The whole percent of 94. Yes? 10.34%. 10.34%. Third bullet. Therefore, loss. Loss equal to 15 minus 10.34, the whole percentage of 50 lakhs. 15 minus 10.34, the whole percentage of 50 lakhs. 15 minus 10.34, the whole percentage of 50 lakhs equal to 2.33 lakhs. Para change. The word used by them was net financial benefit. Write down. Net financial benefit. Net financial benefit equal to 4 minus 2.33. 4 minus 2.33 equal to 1.67 lakhs or 4.44 minus 1.33. 4.44 minus 1.33 equal to, 4.44 minus 2.33 equal to 2.11 lakhs. Next slide. Since net financial benefit is positive, 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 comma, Mr. LX should invest in the multi-cap fund. Mr. LX should invest in the multi-cap fund. Mr. LX should invest in the multi-cap fund. Should invest in the multi-cap fund. Okay. Bring out the portfolio management book, because you can't carry it every day. Let's finish it off. The portfolio management book. First of all, in page number 81, problem 51. Page number 81, problem 51, the second part we had left. Page 81, problem 51. Homework was the first part which you all had done, and the second part was left. Page 81, sum number 51. Okay? Second part. So now you can do it because the second part was systematic risk, beta square into variance of market. Okay, systematic risk is what? Beta square into variance of market. And then total risk minus systematic is equal to what? Unsystematic. Okay, so hope you will be able to do it. There's no issue. Some people have already completed it and are agreeing that yes sir, the answer is matching. Okay, next. Now page number 87, problem 55 is the sum on mutual fund we did today. Page 87, problem 55 is the sum on mutual fund we have done today from the mutual fund book. So tick it, we have done it. Yeah, let's come to the sum. Page number 93. Page number 93, problem 1. Page 93, problem 1. Page 93, problem 1. Mr. Abhishek is interested in investing 2 lakh, for which he is considering following 3 alternatives. Please mark the sum as ambiguous. Oh, its heading was only given. Mr. Abhishek is interested in investing 2 lakh, for which he is considering following 3 alternatives. Alternative 1, invest 2 lakh in mutual fund X. Invest 2 lakh in mutual fund Y. Invest 60% mutual fund X and 40% mutual fund Y. Average annual return earned by mutual fund X and Y, 15%, 14%. Okay, actual return or expected return, whatever, I don't know. Risk-free rate of return 10% RF, market return 12%. So good data given. Covariance of return of MFX, MFY and market portfolio mix are as follows. MFX, MFY, market portfolio. The mix, they are calling it market portfolio. They are calling the mix market portfolio. God knows why. Okay, let's see. You are required to calculate variance of return from MFX. Now this is a joke because the covariance matrix, I had also told you, in the covariance matrix, the covariance of something with its own self is what? Variance. So MFX is not supposed to be computed, it's supposed to be seen. What is the variance of MFX? 4.8. What is the variance of MFY? 4.25. What is the variance of market? 3.1. It's a joke going on the diagonal. Okay? Is the answer matching? Yes? But what these people have done, God knows. Okay? There was straightforward answer. Okay, they written formula and then explained. So, are you okay? 4.8, 4.25, 3.1. Write down by the side of the sum. Write down by the side of the sum, number 1. It's there in the table, diagonal. Write down. By the side of the question, please write down. It's there in the table, the diagonal. It's there in the table, dash, diagonal. It's there in the table, dash, diagonal. Second part. Portfolio return, beta, portfolio variance and portfolio SD. Portfolio return is always weighted average. So it will be 0.6 into 15 plus 0.4 into 14. Calci, please. 0.6 into 15 plus 0.4 into 14. How much? 14.6. Is it matching? Yes, 14.6. Fine with you? 0.6 and 0.4 you understood now, 1 lakh 20 and 80. Yeah. Then portfolio beta is weighted average. So we have to first of all calculate beta of MFX. What is the formula for beta? R is not given. What is the formula for beta? Cov xy by variance of x. X means market. So covariance of MFX with market is 3.37. Can you see in the table? Covariance of MFX with market is 3.37. Variance of market is 3.1. Please divide calci. Are you doing that? 3.37 by 3.1. What's the beta? 1.09. And what is the beta of MFY? 2.8 by 3.1? 0.9. Then weighted average. Check the answer. It's matching. Page number 94 towards the end. Can you see that? Fine. Then they asked us, calculate portfolio variance. What's the formula of portfolio variance? 0.6 square. Keep on looking at the table. Table means the question, not the answer. 0.6 square into 4.8 plus 0.4 square into 4.25 plus 2 into 0.6 into 0.4 into what? 4.3. 4.3. Can you see covariance between x and y? 2 into weight into covariance. Have they done that? Yes, 0.6 square into 4.8, 0.4 square into 4.25, 2 into 0.6 into 0.4 into 4.3. Page 95, first line. Next. Portfolio SD, square root. Okay. So that part is okay. There's no issue. So there is no confusion in the first and second part. Okay, just in the second part, the beta word which is given in the question, a beta word, beta. Over there you please write, by giving an arrow over there, beta. Treat mix as market. Treat mix as market. Treat mix as market. Okay, then only we understood now how to compute beta of x and y. Third part, expected return, systematic risk and unsystematic risk. Of what? Now this is stupidity at its heights. Already the returns were given. 15, 14. Now they ask expected return. They actually want to say the same thing, required return. What do I expect from you? What does your father expect from you? That is not expectation. That is what? Requirement. So write down in the third part. They mean to say RE. They mean to say RE. So how will we know? Because we have done the sum now. Okay, they mean to say RE. So you have to do RF plus RM minus RF into beta. What is the formula for systematic risk? Beta square into variance of market. All that you will do. The only confusion is expected return. That's RE. RE. Fourth part, Sharpe ratio, Trenner ratio and alpha. All the three you have done today. Sharpe ratio, Trenner ratio, alpha. So the only reason why people get blocked over here is because of expected return. It's not expected, it is what? Required. Fine? Okay. The sum can come in the exam, I'm telling you, and people will get stuck up in the sum. This is not clear cut. Okay, mix is treated as portfolio. You got to do it. Okay. Next. Were you able to do page 98, problem 3? Page 98, problem 3, the constant mix. Answer is also correct. So I was thinking it wrong. Yeah. Next. Page number 102, question number 5. Please come to page number 102, question number 5. Page 102, question number 5. That's a normal sum. No ambiguity, nothing. You can mark it as homework. Page 102, question 5. That's a normal sum. No problem at all. In fact, question number 1 is also a homework for you. I have discussed that. This I am not discussing. Were you given page 104, question 6 as homework? Okay, that's another sum of C star in case you are really interested. Page 104, question 6 is another sum on C star. Okay, that depends on your choice, C star. Yeah, somebody is saying something, yes? Just 1 second, somebody is interrupting. Before that, page 104, problem 6 is on C star. I think it need not be done if you have done those two sums, but in case you are interested, no, you have time to do. Yeah, you are asking me to revisit page number? Page 98, problem 3. Let's come back to the sum again. Page 98, problem 3. The homework of the last class, yes. In buy and hold, the full amount is invested in equity. I had dictated this. Okay, there was no confusion. It's okay, fine. Next. Okay, page number 106, question 7. Page 106, question 7. Page 106, question 7. Let's see, I'm not remembering, there could be some ambiguity in it, I don't remember. The following details are given for X and Y company stock and the Bombay Stock Exchange Index for 1 year. Calculate systematic, unsystematic risk for the stocks. If equal amount of money is allocated for the stocks, what would be the portfolio risk? Half of weight, portfolio risk. So first of all, we are required to calculate systematic, unsystematic risk for the stocks. Let's see. X, Y, Sensex, return 15, 25, 6. Variance 6.3, 5.86, 2.25. Beta 0.71, 0.685. Correlation 0.424. R square 0.18. Okay, just check whether it's matching. 0.424 square. 0.424 square, is it coming to 0.18? Yes. So the first question was systematic risk. What's the formula? Beta square variance of market. Everybody check the beta of X. What was the beta of X? 0.71. So 0.71 square into 2.25. 0.71 square into 2.25. 1.134. That's fine. Okay, so company Y will also be fine. We are checking just X. Unsystematic risk. Now, do you know the interpretation of R square? R square 0.18 means 18% of the total risk is systematic. So 82% is what? Unsystematic. 82%, not 82% of total risk. The total risk of X is 6.3. Calci, please. 82% of 6.3. Check. 5.16 answer. Okay, so that answer I have done on the basis of R square. But you can do it only if you remember the meaning of R square. R square means out of the total risk, 18% systematic. So 82% what? Unsystematic. Okay. Then they had asked portfolio risk. So portfolio risk, the formula would be, look at the question data. Question data, I'm speaking out the numbers. Don't look at the answer, the question data. 0.5 square into 6.3. Are you okay? Plus 0.5 square into 5.86. Plus 2 into 0.5 into 0.5 into 0.424. No. Sorry. 0.424 is the correlation between what? Between X and Y. That's strange. So we can do that way, na? 0.5 square into 6.3 plus 0.4 square into, sorry, 0.5 square into 6.3 plus 0.5 square into 5.86 plus 2 into 0.5 into 0.5 into 0.71 into 0.685 into 2.25. Beta A into beta B into variance of market. 2 into weight into covariance. What was the new formula of covariance? Beta A into beta B into variance of market. Just try that. Now they've not done it that way. Let's try that. Solution, last part in the copy. Sigma square P equal to 0.5 square into 6.3 plus 0.5 square into 5.86 plus 2 into 0.5 into 0.5 into beta A 0.71 into beta B 0.685 into 2.25. Please calculate. Okay, weight square into variance, 2 into weight into covariance. And covariance is beta A into beta B into variance of market. Yes, please. 3.5876. It's coming to that. Okay, 3.59 or 3.5876, that is the institute's answer. So no problems. Okay. So by virtue of this, we have done all sums on portfolio. Okay. The MFX, MFY sum, I was worried because I can see that it can come in the exam and then there will be a problem. You need to write and do that sum, write and do, not see, write and do the sum. So portfolio management is over. You don't need to bring this book next class. Only mutual fund book you will continue to bring. And mutual fund may take 3 classes instead of 2 because we are doing extra stuff now. So it may take 3 classes. That is, today is Wednesday. So Thursday and Friday to complete what? Mutual funds. Once mutual fund gets over, next week we start equity, which will take around 8 classes, and then merger will take around 4 classes. So 8 and 4 what? 12, and 3 classes of theory. 12 and 3, 15 from Monday onwards. From Monday onwards. Understood? So how many classes left? If you wanted to count, 2 classes of mutual fund. Okay, and then 15 more. How much? 17. 17 classes totally left after today. Okay, to cover everything. Okay.